Hi, my name is Salman Sheikh. Welcome to this learning session of futures and options trading. So in this video, I'll be talking about the futures market, and this will give you an introduction to the futures trading, and learning this lesson will help you and give you confidence in futures trading. So our channel basically focuses on futures and options trading. So you must go to the channel and visit all the videos. I explain to you with live examples how to do options trading. And I've shown you ways to do futures trading with a lower margin using options as well. So please do check out all those videos. There will be a series of videos in which I will be explaining you all how to do futures and options trading from the basics. So this will be mostly theoretical, and then with this theory we'll apply to the practical world. And for live examples, you should definitely check out my videos. So I have shown you through my Zerodha terminal, and I have shown you the live recording how I do trading and use all this theory into practical. Let's enter the world of derivative market. And in this derivative market, there are futures and options. Basically, these two are the instruments that we have. For futures trading, I will explain you from the basics. Before we move on to the futures and I deep dive into the futures, let's start a journey with the forwards market. So what is a forwards contract or the forwards market? I'll explain you that first. I will also be using a presentation to explain this to you. Futures market is an integral part of the financial derivatives world. Derivatives, as they say, are the security whose value is derived from another financial entity referred to as an underlying asset. The underlying asset can be a stock, bond, commodity, or a currency. The financial derivatives have been around for a long time now. The earliest reference to the application of derivatives in India dates back to as old as 320 BC in Kautilya's Arthashastra. Of course, those who are familiar with the Vedic terms and the Vedic literature would know this. Study of this economic script or the Arthashastra script, Kautilya described the pricing mechanism of the standing crops ready to be harvested at some point in future. Apparently, he used this method to pay the farmers much in advance, thereby structuring a true forwards contract. Yes. So when you decide the payment in advance, that is the true forwards contract. So given the similarities between forwards contract and the futures market, I think the best possible way to introduce the futures market is by first understanding the forwards market. The understanding of forwards market would lay a strong foundation in learning the futures market. The forwards contract is the simplest form of derivative. Consider the forwards contract as the older avatar of futures contract. Now both the futures and the forward contracts share a common transactional structure, except that the futures contract have become the trader's default choice over the years. The forwards contract are still in use but are limited to a few participants such as the industries and the banks. The focus is to help you understand the structure of a typical forwards transaction, after which we will break it down into its small elements and understand its advantages as well as disadvantages. Now let me explain this forwards contract to you through a simple example. Now a forward market was primarily started to protect the interest of the farmers from adverse price movements. Now in a forward market, the buyer and seller agree to exchange the goods for cash. The exchange happens at a specific price on a specific future date. But the goods price is fixed by both the parties on the day they agree. Similarly, the date and time of the goods to be delivered is also fixed. Now the agreement happens face to face with no intervention from a third party. And this is called over-the-counter agreement or OTC agreement, where individuals, institutions trade through negotiations on a one-on-one basis. Consider an example where two parties are involved. Now consider a jeweler whose job is to design and manufacture the jewelry. Let's call him an ABC jeweler, and the other is a gold importer whose job is to sell gold at a wholesale price to these jewelers who design and manufacture the jewelries. Let's call this dealer, the gold dealer, as an XYZ gold dealer. Now suppose on 1st of Jan 2021, ABC Jewelers agreed with XYZ to buy 15 kilograms of gold at a certain purity, say 99.99% purity, in 3 months. Let us assume 30th of March 2021. Now they fix the price of gold at the current market price. So let us assume the current market price of gold in a rounded figure. So let us assume it to be 4,500 per gram or 45 lakhs per kilogram. That is, in March end, ABC has to pay XYZ, that is the jeweler, has to pay the gold importer around 6.75 crores, for that is the total agreement value of 15 kg of gold, considering 4.5k as the price of gold per kilogram. This is a very straightforward and typical business agreement that is prevalent in the market. An agreement of this sort is called a forwards contract or a forwards agreement. Now do note, the agreement executed on the 1st of Jan 2021, irrespective of the price of gold in the 3 months later, that is by the end of March, and both ABC and XYZ, that is the jeweler and the gold importer, are obligated to honor this agreement. Now before we proceed further, let us understand each party's thought process and understand what compelled them to enter this agreement. Now why do you think the jeweler agreed to enter this agreement? Well, the jeweler believes that the price of gold would go up in the next 3 months. Hence, they would want to lock in today's market price for the gold. Clearly, the jeweler wants to insulate itself from an adverse increase in the gold price. As we can see, the gold prices are rising. Suppose you made a forward contract maybe a couple of years ago. As a retailer, if you had made an agreement with the jeweler in a forward contract maybe a couple of years ago to purchase gold at that price in future, so here you would actually be sitting on a huge profit because the gold prices have increased in future. So in a forwards contract, the party agreeing to buy the asset at some point in the future is called the buyer of the forwards contract, and in this case that is the jeweler, the ABC jeweler. Likewise, the importer of the gold or the person who is selling the gold to the jeweler, so the XYZ gold importer believes that the price of the gold will go down in the next 3 months. Hence, they want to cash in on the higher price of gold available in the market today. Well, in forwards contract, the party agreeing to sell the asset at some point in the future is called the seller of the forwards contract. In this case, it is the XYZ dealers or the gold importers. Now, both the parties have an opposing view of gold. Hence, they see this agreement to be in line with their future expectations. Now, while both the parties have their own view on gold, only 3 possible scenarios can occur. Now, let's consider scenario 1 when the price of gold moves higher. Now, assume by the end of March, the price of gold started trading around 5,000 rupees. Now, clearly, the jeweler's view on the gold price has come true. Now, at the time of agreement, the deal was valued at 6.75 crores. But now, when the price of the gold has increased to 5,000 rupees per gram, the value of the deal has increased to actually 7.5 crores. So, as per the agreement, ABC Jewelers is entitled to buy that gold of 99.9% purity from XYZ Jewelers at the price they had agreed upon previously, that is 4,500 rupees per gram. Hence, in this scenario, both the parties are impacted by the increase in the gold price. ABC Jewelers is impacted in a positive way by gaining 75 lakhs from this contract, whereas at the same time, the XYZ dealers is losing 75 lakhs of value which he could have gained if he would have not taken the contract and sold in the March itself. Let's consider the second scenario where the price of gold decreases from 4,500 to actually 4,000. The original contract, which was valued at 6.75 CR, actually the value of the contract comes down to 6 CR. And in this case, the ABC Jewelers has to pay the XYZ dealers the original value of the contract, that is 6.75 CR. But as a result of this price decrease, both the parties are impacted, and at this time, value of the contract has decreased from 6.75 CR to 6 CR, and hence the dealer tends to gain 75 lakhs, whereas the ABC Jewelers tends to lose in these transactions. So the ABC Jewelers incurs a financial loss of 75 lakhs. Now suppose in the third scenario, the price of gold does not move, or if it moves up or down during a period, but if the contract is only supposed to be executed by end of March and at the 30th of March, the price of gold It moves from 4,500 anywhere up and down, and it comes back to 4,500. Either of the parties, the jeweler or the importer or the gold dealer, does not seem to be impacted by this contract. So the value remains the same, that is 4,500 rupees per gram, and either of the parties do not incur any profit or loss from this transaction. So all this you can see in the presentation, how the prices of gold are impacting. Let me just explain you a quick thing on settlement. Suppose this contract expires on 30th of March of 2021, then both the parties may decide on how they want to settle. So there is one way to do a physical settlement. In physical settlement, the dealer has to give the delivery of gold in March at the agreed upon contract value. So if the dealer had purchased the gold in March and if the price has increased, then he has to pay the increased value of the gold imported and give it to the jeweler. If the gold price has decreased, then the dealer gets benefit, and then he can import the gold at a lower price and give it to the jeweler. And the second case is a cash settlement. If the gold importer and the jeweler agree, they can do a cash settlement. In the cash settlement, the difference, the profit or the loss, is paid by either of the parties. So suppose the price of the gold has increased, then the dealer would actually pay the 75 lakhs worth of increase in the contract value to the jeweler because of the price increase, whereas when the price decreases, then the jeweler may actually pay 75 lakhs to the dealer. So this can happen if both parties agrees or if there is something mentioned of cash settlement in the agreement. Now we will understand a lot more about the settlement at a much later stage. Still, at this stage, you need to be aware that there are basically two basic types of settlement options available in the forwards contract, that is physical and cash. Now what about the risk? So let me explain you the risks. So while we are clear about the structure, terms and conditions of the agreement and the impact of the price variation on either party, what about the risk involved? Do note, the risk is not just with price movements. There are other major drawbacks in forwards contract, and I will explain to you one by one. The first risk here is the liquidity risk. Now in our example, we have conveniently assumed that is the jeweler ABC finds a party of the importer XYZ who has the exact opposite view on the price trend of gold. Hence, they easily strike a deal. In the real world, this is not so easy. In a real life situation, the parties would approach an investment bank and discuss their intention. The investment bank would scout the market to find a party who has an opposite view. Of course, the investment bank does this for a fee. Now there is also a default risk or the counterparty risk. Assume that the prices by the end of 3 months have increased. 4.5k of gold per gram is now selling at 5k per gram. ABC jewelers would feel proud of their financial decision they had taken 3 months ago, and they are expecting XYZ to pay up. But what if XYZ defaults or declares bankruptcy or just runs away with your money or does some kind of financial fraud and doesn't pay up? What will you do then? So that is called a risk of defecting or the default risk. The regulatory risk. The forward contract agreement is executed by mutual consent of the parties involved, and there is no regulatory authority governing the agreement. In the absence of a regulatory authority, a sense of lawlessness creeps in, which in turn increases the incentive to default. Now let's also discuss the rigidity. So both ABC and the XYZ, that is the seller and the buyer, have entered into the agreement on 1st of January 2021 with a certain gold view. Now however, what would happen if the view would strongly change when they are halfway through the agreement? The rigidity of the forwards contract is such that they cannot foreclose the agreement halfway through. So suppose by the end of Jan you feel no, the gold prices are already rose around 100-200 rupees, but if the dealer XYZ wants to close the agreement and just wants to square off its losses, so he cannot do that. So this is the rigidity of forwards contract. The forwards contracts have a few disadvantages, and hence futures contracts were designed to reduce the risk of the forwards agreements. In India, the futures market is a part of a highly vibrant financial derivatives market. During this series of videos where I will be explaining the futures and the options trading, We will also learn more about the futures and the methods to trade the instrument so efficiently. So let's go ahead and hit the road. So allow me to summarize what I've explained. So the forwards contract actually lays down the basic foundations of a futures contract. A forwards contract is like an over-the-counter agreement which is not traded in any exchange. A forwards contract is also a private agreement between the two parties whose terms can vary from one agreement to another agreement. The structure of the forwards contract is fairly simple. In the forward agreement, the person or the party who is trying to buy the asset or the underlying is called the buyer of the forwards contract. In the forwards agreement, the seller of the underlying or the asset is called the seller of the forwards contract. A variation in the price could affect both the buyer as well as seller of the forwards contract. And a settlement can take place in two ways in the forwards contract, that is the cash settlement or the physical delivery or the physical settlement. I've also explained that the futures contract actually reduces the risk of the forwards contract, and the core of the forwards and the futures contracts remain the same. So now that you understood the forwards contract, let me introduce you to the world of futures. So in the previous discussion of forwards contract, we looked at a straightforward forwards contract example where two parties agreed to exchange cash for goods at some point in the future. We inspected the structure of the transaction and understood how the variation in price impacts the parties involved. We had listed down 4 key risks or the issues concerning forwards contracts, and we concluded that futures contract is structured to overcome the critical risks of a forwards agreement, namely liquidity risk, default risk, regulatory risk, and rigidity in transactional structure. Let's keep the forwards contract example in mind of the jeweler and the dealer. So we also learned from the example that if your view of a underlying asset is right, then you can significantly benefit from the forwards agreement or the forwards contract. All one needs to do is to find a counterparty willing to take the opposite side. Needless to say, a forward agreement is limited by the inherent risks involved, all of which is overcome by a futures agreement. So the futures contract or the futures agreement is actually an improvisation of the forwards contract. Now the futures contract is designed so that it retains the core transactional structure of a forwards contract. At the same time, it eliminates the risks associated with forwards contract. Now a forwards agreement would give you a financial benefit as long as you have an accurate directional view of an asset price. This is what I mean when I say core transactional structure. This may seem a bit absurd when you think about it, but the transactional structure of an old generation car was to transport you from a point A to a point B. However, the new generation car comes with improvisations in terms of safety features, airbags, seat belts, ABS, power steering, etc. However, it still retains the core transaction structure, that is to help you move from point A to point B. This is the same distinction between forwards agreement and a futures agreement, an old car versus a new car. So let me give you a sneak peek into the futures agreement. So as we know, the core transactional structure of the futures and forwards contract is the same, and I guess it makes sense to look into the futures that distinguish the futures from the forwards. We will have a quick sneak peek into these features, but we will also dig into each feature in greater detail at a later stage. Recall in the example where the jeweler ABC agrees with XYZ to buy a certain quantity of gold at a certain point in the future. Now imagine this. What if ABC found it really hard to find XYZ as a counterparty to the agreement? Under such circumstances, though ABC has a certain view on gold and is willing to enter into financial agreement, they would be left helpless because there is no counterparty to take the opposite side of agreement. Now further imagine this. What if ABC jeweler, instead of spending its time and effort to scout for a counterparty, decides to walk into a financial supermarket where many counterparties are willing to take the opposite view? With such a financial supermarket in place, ABC has to announce its intention and the willing counterparties would line up to take the opposing stance. What more, a true financial supermarket of this sort would not just have people with a view on gold, but instead it will also have people with a view on silver, copper, crude oil, and pretty much any other asset class including stocks. In fact, this is exactly how the futures contracts are made available. They are available and accessible to all of us and not just available to corporates such as the ABC jewelers or XYZ dealers. The futures contracts are available to us in financial supermarket, often called the exchange. The exchange can be stock exchange or commodity exchange. As we know, a futures contract is structured slightly differently than the forwards contract. This is definitely to overcome the risks that are involved in the forwards market. So let us look at each of these points that differentiate the futures contract from the forwards contract. Note that you may still not be very clear about futures. That's alright. Keep the following points in perspective. We will shortly consider a futures example as well, and with that, you should be clear about how futures agreement works. The futures contract actually mimics the underlying. In the example of ABC jewelers and XYZ dealers, the forwards agreement was based on gold, an asset and its price. However, when it comes to a futures contract, the agreement is based on the asset's future price. The future price mimics the asset, which is also called the underlying. For example, gold as an asset can have a gold futures contract. Please think of the underlying and its futures contract somewhat as twin siblings. Whatever the underlying asset does, the futures contract does the same. Therefore, if the price of the underlying goes up, the futures contract's price would also go up. Likewise, if the price of the underlying asset goes down, the futures contract's price also goes down. Second point you have to note is that there are standardized contracts. Again, going back to the example of the ABC jewelers and the XYZ gold dealers, if both the parties mutually agreed, the agreement could have been for 14.5 kgs or 15.25 kgs or whatever they would have think is convenient for them. However, in the futures contract, the parameters are standardized. They are not negotiable. The futures contracts are tradable. That is, you can trade the contracts as well. The futures contract is easily tradable. If I get into an agreement with a counterparty, unlike a forwards contract, I need not honor the contract until the end, also called the expiry. At any point in time, if my view changes, I can transfer the contract to someone else and get out of the agreement. Also, the futures market is highly regulated. Our regulatory authority highly regulates the futures markets, or for that matter, the entire financial derivatives market in India. In India, the regulatory authority is called Securities and Exchange Board of India, or the SEBI. This means there is always someone overlooking the activities in the market and making sure things run smoothly. This also means default on futures agreement is hardly a possibility. The futures contracts are time bound. We will understand this point in detail a bit later, but for now, remember that all the futures contracts available to you have different time frames. In the examples that I had shared earlier, the ABC jewelers had a certain view on gold, keeping 3 months in perspective. If ABC were to do a similar agreement in futures contract would be available to them in the 1 month, 2 months or 3 months time frame as well. The time frame up to which the contract lasts is called the expiry of contract. Cash settled. So most of the futures contracts are cash settled. This means only the cash differential is paid out. There is no worry of moving the physical asset from one place to another. The cash settlement is overseen by regulatory authority, ensuring total transparency in the cash settlement process. So to sum up the difference between the futures contract as well as the forwards contract, I will present a table to you. So you can save this for future reference. So at this stage, I feel there is a need to stress the distinction between the spot price and the futures price. So the spot price is the price at which the asset trades in the regular market, also called the spot market. For example, if we are talking about gold as an underlying, then there are two prices we are referring to. Gold in the regular market called the spot market and gold in the futures market called the gold futures. The spot market prices and futures market prices move in tandem, meaning if one goes out, then the other also goes up. With these points in a perspective, let us also focus on few other points or the nuances in futures contract. But before you go on and trade your first futures, let us understand few more points. Before we dig deeper and understand the workings of futures contract, we need to understand a few other aspects of futures trading. Do remember, at a later stage, we will revisit these points and discuss them in greater detail. But for now, good working knowledge on the following points is what is required. So let us discuss first about the lot size. Futures is a standardized contract where everything related to the agreement is predetermined. So the lot size is one such parameter. Lot size specifies the minimum quantity that you will have to transact in a futures contract. So lot size varies from one asset to another. So second is the contract value. So in our example of the ABC jewelers and the XYZ gold dealers, we saw that ABC agreed to buy 15 kgs of gold at a rate of 4,500 rupees per gram, or the contract value which came out to be was 6.75 CR. So in this case, we can say that the contract value for 15 kgs of gold at 4,500 per gram is turning out to be 6.75 crores. So simply put, the contract value is the value of the price of the full quantity of the asset. So we know the futures agreement has a standardized predetermined minimum quantity. The contract value of the futures agreement can be generalized to lot size into price. Also, you should know what is margin. Now again, referring back to the example of ABC jewelers and XYZ gold dealers, at the time of agreement, that is on the 1st of Jan 2021, both the parties would have had a gentleman's word and nothing beyond that. Meaning both the parties would have just agreed to honor the contract on the agreement's expiry, that is on the end of March or the 30th of March, let's assume 2021. Do notice there is no exchange of money when the contract is established, that is on 1st of Jan. However, in the futures agreement, the moment a transaction occurs, both the parties involved will have to deposit some money. Consider this as the token advance required for agreeing. The money has to be deposited with the broker. Usually the money that needs to be deposited is calculated as a percentage of the contract value. This is called the margin amount. Margins play a pivotal role in futures trading. We will understand this in a greater detail later. For now, remember that to enter into a futures agreement, a margin amount is required, which is a certain percentage of the contract value. Expiry. As you know, all futures contracts are time bound. The expiry or the expiry date of the futures contract is the date up to which the contract agreement is valid. Beyond the valid date, the contract ceases to exist. Also, be aware that the day a contract expires, exchanges introduce new contracts. So now knowing the basics and some of the few terminologies of the futures contract, you will be clear in understanding the examples which I explained to you in future. So the key takeaways from this discussion of futures contract is that the forwards and the futures markets give you financial benefit if you have an accurate directional view of the asset price. So the futures contract is also the improvisation of the forwards contract. And futures price generally mimics the underlying price in the spot market. And unlike the forwards contract, the futures contract is tradable. Also, the futures contract is standardized contract wherein all the variables of the agreement is predetermined. And futures contract are time bound and the contracts are available over different time frames. Now, most of the futures contracts are cash settled. And SEBI regulates the futures market. Lot size is the minimum quantity specified for the futures contract. You can trade in the multiples of lots. So if the lot size is suppose 10 quantity of the underlying, then you can trade in 10, 20, 30, 40 such way. And contract value is equal to lot size into the price per quantity. And to enter the futures agreement, one has to deposit a margin amount, a certain percentage of the contract value. That is called the margin money or a safety deposit, for you to agree upon the contract. And even the futures contract has an expiry date beyond which the contract would cease to exist. Upon expiry, old contracts cease and new ones are created. So guys, this is all about forwards contract and the futures contract, which will help you in futures trading. In coming videos, we'll also learn more about the futures trading with practical examples. So in case you like the video, do hit the like button and subscribe to my channel for more such videos which will help you learn the futures and options trading and generate huge profits. It's always good to learn something and do it. So once you learn it, you can gain confidence. If you have any queries or questions, do let me know in the comments below. If you have any theoretical question or a practical question, do let me know in the comments below. I will definitely answer those queries. So see you again in next video. Until then, happy learning. Adios.